All participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. We have our senior management of LIC led by Mr. Siddhartha Mohanty, Chairperson on this call. I now hand the conference over to Mr. Siddhartha Mohanty, Chairperson LIC. Thank you, and over to you, sir.
Thank you. Good morning, everyone. I am Siddhartha Mohanty, Chairperson LIC. On behalf of the senior management team, I warmly welcome you all to the results and performance update call of Life Insurance Corporation of India for the third quarter and 9 months period ended December 31st, 2023. The results and a presentation can be accessed on our website and on websites of both the stock exchanges, BSE and NSE. Along with me on this call, I have 4 managing directors, Mr. M. Jagannath, Mr. Tablesh Pandey, Mr. Satpal Bhanu, and Mr. R. Doraiswamy. Senior officials of the corporation present on this call are Mr. Dinesh Pant, Appointed Actuary and Executive Director, Mr. K.R. Ashok, Executive Director from the Actuarial team, Mr. Sunil Agarwal, CFO from the Finance team, Mr. Ratnakar Patnaik, Executive Director, Investment Front Office and CIO, Mr. K. Sesagiridhar, Executive Director, Investment Back Office from the Investment team, Mr. R. Sudhakar, Executive Director, Marketing and CMO, Mr. Hemant Buch, Executive Director, Bank Assurance, Ms. Manju Bagga, Executive Director, Pension and Group Business, Ms. Anjuvala Purushottam, Executive Director, CRM, Claims, Annuities, Ms. Rachna Khare, Executive Director, CRM, Policy Servicing, and Mr. Sanjay Bajaj, Head, Investor Relations. I would like to thank all of you for sparing your valuable time to join this call today and listen to the LIC team. Let me now mention the key business, operational and financial highlights for the first 9 months of the financial year 2023-24. Premium income. For the 9 months ended December 31st, 2023, we have reported a total premium income of INR 3,22,776 crore as compared to the total premium of INR 3,42,244 crore for the corresponding 9-month period of last year ending December 31st, 2022. The individual new business premium income for 9 months FY24 is INR 38,679 crore, and for comparable 9 months FY23 it was INR 38,828 crore. Renewal premium income individual business for 9 months FY24 is INR 1,71,040 crore as compared to INR 1,61,601 crore for 9 months FY23. Therefore, for 9 months ending December 31st, 2023, our total individual premium income, including renewal, is INR 2,09,719 crore as compared to INR 2,04,29 crore for 9 months ending December 31st, 2022. As measured by total individual premium, we have grown by 4.64% on year-on-year basis. The group business total premium income for 9 months ended December 31st, 2023 is INR 1,13,057 crore, comparing of new business premium of INR 1,08,796 crore. In comparison, for 9 months ended December 31st, 2022, last year the group business total premium income was INR 1,41,815 crore and comprised new business premium of INR 1,37,240 crore. Therefore, for 9 months ended 31st December 2023, total group premium has declined by 20.28% as compared to similar period of previous. Hence, our overall premium for 9 months ended December 31st, 2023 has registered a decline of 5.69%. Our market share by first year premium income is 58.90% as per IRDAI report for 9 months period ended December 31st, 2023 as compared to 65.38% for the similar 9 month period ended December 31st, 2022. If we were to split this total market share of 58.90% into segment-wise share of individual and group business, we will have a market share of 38.74% in individual business and 72.24% in group business for 9 months ending 31st December 2023. On a comparable basis for 9 months ended 31st December 2022, the respective market share for individual and group business were 40.93 and 78.65%. Therefore, we continue to retain the leadership position in both individual and group business segments in the Indian insurance industry. I would also add that we are conscious about doing profitable business. In an AP basis, the breakup of business is as follows. Total annualized premium equivalent APE for 9 months ended 31st December 2023 is INR 35,790 crore, which is comprised of individual AP of INR 23,503 crore and a group AP of INR 12,287 crore. Therefore, on AP basis, the individual business account for 65.67% and group business accounts for 34.33%. Further, of the individual AP, the par business accounts for INR 20,203 crore and non-par amounts to INR 3,299 crore. As you can see, our par share of individual AP is 85.96% and the non-par is 14.04% for 9 months FY24. You will recall that our non-par share for the year ended 31st March 2022 and 31st March 2023 on AP basis within the overall individual business was 7.12% and 8.89% respectively. Further, you will also remember on the last call on November 10th, 2023, we had mentioned about our non-par mix to be 10.76% for H1 of FY24. At this point, I would like to emphasize that our strategy of focusing on changing product mix by launching new non-par products and marketing the same in a focused manner to meet our customer needs is showing results as we had envisaged. While we have shared non-par mix for the period of 3 months, 6 months, 9 months as a disclosure, you can very well arrive at your own estimates of how the successive months and quarters are getting better for us on this aspect since we have been listed. Profit after tax. The profit after tax for the 9 months ended 31st December 2023 was INR 26,913 crore as against INR 22,970 crore for the 9 months ended 31st December 2022. The current 9 month period profit includes the transfer of an amount of INR 21,461 crore net of tax pertaining to the accretions on the available solvency margin from non-par to shareholders account. The amount of 21,461 crore INR comprises of INR 7,692 crore for the quarter ended 31st December 2023 besides INR 6,277 crore and INR 7,492 crore for the quarter ending 30th June 2023 and 30th September 2023 respectively. At this point, I must highlight that the 9 month profit of FY24 is not comparable to the published 9 month profit figures of FY23. Therefore, I will request our CFO, Mr. Sunil Agrawal, to provide details after my opening remarks and before the start of the Q&A session today. VNB and VNB margins. Value of new business is INR 5,938 crore for the 9 months ended December 31st, 2023, as compared to VNB of INR 5,478 crore for the 9 months ended December 31st, 2022. As you can see, the VNB has registered an increase of 8.40% on year-on-year basis. Further, the net VNB margin for the 9 months FY24 is 16.6% as compared to 14.6% for 9 months ended December 31st, 2022. Hence, the VNB margin has expanded by 200 basis points on a year-on-year basis. In comparison, you will also remember that our VNB margin for the past 6 months of FY24 ended September 30th, 2023 was 14.6%. Therefore, the 9 months ended December 31st, 2023 results also demonstrate the positive impact of changing product mix in Q3 of FY24 when new products have been launched. Solvency ratio. The solvency ratio as on December 31st, 2023 improved to 1.93 as against 1.85 on December 31st, 2022. Assets under management. AUM as on 31st December 2023 grew by 11.98% year-on-year to INR 49,66,371 crore as compared to INR 44,34,940 crore as on December 31st, 2022. Product mix and new product launches. Now I would like to inform about new product launches. In line with our strategy of increasing the proportion of the non-par business, we launched new non-par products during the past 9 months of FY23-24 to cater to customer requirements, namely LIC's Dhan Vriddhi Plan, LIC's Jivan Kiran Plan, LIC's Jivan Utsav Plan, and LIC's Group Post-Retirement Medical Benefit Plan respectively. Number of policies sold. During the 9 months ended December 31st, 2023, we sold 1.25 crore new policies as compared to 1.28 crore policies in the 9 months ended December 31st, 2022, registering a marginal decline of 2.6% over the corresponding period of last year. Agency workforce. As on December 31st, 2023, the total number of agents was 13.7 by number of agents as on 31st, 2023 stands at 49.67% as against 52.3% for December 31st, 2022. Therefore, we have a net addition of approximately 51,000 agents in last 1 year. On number of policies sold basis, the agency force has sold 1.21 crore policies during the 9 months ended December 31st, 2023 as compared to 1.24 crore policies during the corresponding period of last year, registering decline of 2.39%. Therefore, more than 96% of our policies for the past 9 months of FY24 were sold by our agency force. Even on premium basis, approximately 96% of new business premium came from our agency channel for 9 months FY24. Contribution of banca and alternate channel. During the 9 months ended December 31st, 2023, other channels, banca and alternate channels, collected new business premium aggregating 1,423 crore, which was 1,355 crore for 9 months ended 31st December 2022, registering a growth of 5.02% on year-on-year basis. With this, the share of banca and alternate channel has increased to 3.69% for 9 month period ended 31st December 2023 as compared to 3.50% for similar period of last year. Our overall expense ratio stands at 15.28% for the 9 months ended December 31st, 2023, as compared to 15.26% for the same period last year. As you can see, the increase was very, very marginal, 2 basis points on year basis. Persistency. On premium basis, the persistency for 13th, 25th, 37th, 49th and 61st month for 9 months FY24 stands at 78%, 71.92%, 67.28%, 64.92%, 62.40% respectively, as compared to 77.61%, 71.32%, 68.31%, 64.70% and 62.73% respectively for 9 months FY23. On number of policy basis, the persistency for 13th, 25th, 37th, 49th and 61st month for 9 months FY24 stands at 67.22%, 58.59%, 54.80%, 52.01% and 50.23% respectively, as compared to 64.99%, 59.06%, 55.32%, 52.45% and 51.42% respectively for 9 months FY23. Operational efficiency and digital progress. In our digital initiatives through the agent-assisted Ananda app, we have completed 7,84,856 policies through this app during the 9 months ended 31st December 2023, as compared to 5,31,792 policies for the comparable period ending December 31st, 2022, thereby registering a growth of 47.59% on year basis. I feel very happy to let you know that more and more agents are adopting to do business on Ananda. We had also announced during the last call that we have started a digital transformation project called DIVE, Digital Innovation and Value Enhancement, and that we have taken on board a top reputed international consulting firm for this project. Claims. On the claims front, during 9 months FY24, we have processed 1,38,02,767 number of claims, which includes 1,32,04,597 maturity claims. On an amount basis, during 9 months FY24, maturity claims were INR 1,30,222 crore and the death claims were INR 16,288 crores. On a comparable basis for 9 months FY23, maturity claims were 1,13,936 crore and death claims were INR 17,350 crore. Therefore, the death claims are lower by 6.12% and the maturity claims are higher by 14.29% on a year-on-year basis. In summary, I would like to make 3 points. First, our efforts towards changing our product mix are succeeding and we have been able to increase our non-par share within the individual business to 14.04%, which is a significant increase from 7.12% around the time of our listing. Secondly, we are able to launch products that are competitive, meet customer expectations and the needs of various marketing intermediaries and channels. Finally, our sharp focus on enhancing margins in the business is also yielding results, as is evident in the 200 basis points increase in VNB margin to 16.6% on a year-on-year basis. Before I close my opening remarks, I would like to share that the board has approved an interim dividend of rupees 4 per share in its meeting held on 8th February 2024. We are thankful to our customers, shareholders, employees, agents, marketing channels for their faith and trust in us. We remain committed to maintaining our leadership in the market while delivering superior value to all our stakeholders. Thank you very much. Before we open the floor for questions, I would like to invite the CFO, Mr. Sunil Agrawal, to explain the profit numbers, especially with respect to the comparable numbers for similar period last year. Sunil.
Thank you, sir. Good morning, everyone. The profit figures for the quarter are comparable. The profit figure for the quarter, 9,444 crore, is comparable with the quarterly profit of last year, 6,334 crore, which is a 49% increase. The profit number for 9-month period ended December 2023 is not comparable with the 9-month period ended in the previous year, because the previous year included accretion of ASM for the quarter ended 31st March 2022 also, which amounted to rupees 4,542 crore. So if we remove that from 22,969 crore, the profit for 9 months, the comparable profit for the 9-month period 31st December 2022 is 18,427 crore, which is comparable to the profit for 9-month period ended December 31st 2023, which is 26,913 crore, which is a 46% increase in profit, comparable profit. Thank you.
Thank you. We now invite questions.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Sujit Jain from Bajaj Allianz. Please go ahead.
Mr. Mohanty and team, our compliments on a great set of numbers. Sir, I wanted to check with you the sustenance of this VNB margin going into Q4, and what would be the guidance for FY25 and over medium term, and if not guidance, in terms of your aspiration, how VNB margins will pan out next year and in the medium term, let's say over a period of 3 years?
Actually, it would not be appropriate to guess any specific figure, but as you observe, whatever commitment we made during listing, we are in line with achieving our commitment. From 14.4% to 16.6% now, and you see the product mix, we are launching high margin products. And it is not only for shareholder, but first we keep in mind customers' interest. So those products get traction in the market, and in coming days we will continue this effort, and margin, my sense is it will definitely improve and it will be competitive in the market in coming days.
Okay, and you have, sir, mentioned in a variety of your interactions in post-listing about improving on 3 vectors, and in the initial commentary you given the progress on these 3 vectors as well, which is product mix, channel mix, and digital intervention. Specifically on product mix and channel mix, you've given numbers, but directionally, where do you see LIC going in FY25 on these 2 vectors, product mix and channel mix?
The product mix, channel mix, you see, already it has shown results. Product mix, new products we have launched, and if you see the share of AP has gone up like substantially, it has gone up, and in coming days also new products which will be launched that will take care of customer as well as all other stakeholders. So definitely this product mix will help not only margin but share and good growth will be there. But at the same time, channel mix, when we say our alternate channel, we are focusing alternate. And since there has been directional change and focus is more on non-par at present, some impact has been there on par. Or TMO will decide.
Yes, as our chairperson put it, there will be some impact on the par side also. At the same time, we are focusing that the different categories of agents are having their specializations and they are actually selling their products. That is why par continues to be the large proportion of business which we are having today. There are very strong plans which are there in par also, which have actually grown. At the same time, during the last year, there were also revisions which were made in some of the plans in the par business, increasing the sum assured and increasing the ticket size in certain cases. So such increases have impacted a little bit of a number of policies in those plans, which have been compensated more than in the non-par side through the non-par products which we have been launched in the recent past.
Got it. But sir, given this strategy, can we expect a positive growth to happen in FY24 or growth to come back in FY25 in total APE terms? Or you are okay with not growing as significantly, but mix changing and resulting in the margin?
No. Definitely, we would like our growth trajectory to be there. In fact, it is already on track to that, and it will be the AP growth will also continue to be our driver. So that's very much on the focus, and that if you see quarter to quarter, that situation has improved. In fact, in the individual side, it is already there is a AP growth which is already there. So if we we are looking forward to having rational margin improvement, VNB improvement, as well as the AP growth. Because without AP growth and the combination of the margin, the overall VNB won't grow. So that direction is very clear for the corporation. We will continue doing it.
Okay, sir. Perfect. And last one, just on group business, on overall basis, it has declined for 9 months. Just if you can give a little color on the group business, what led to this decline, whether it is GTL or fund-based business or annuity, and your outlook on say GTL or annuity. What is your outlook given it has declined in the current year?
Actually, group business is some of the big ticket we could not get in time, so those are coming. If you see whatever decline was there in Q2, that has been reduced in Q3, and if I tell today, it has further improved. So I am confident whatever target is there for group business, we will definitely achieve in the current year, because we are getting confidence from all our customers, big clients, so they are gradually releasing money.
Sir, but this pressure is largely in annuity or GTL or it's more in fund-based business, the moderation in the growth in group.
This is Manju looking after
this side.
So there is definitely a reduction in the funded business, and that is because funded business is a lumpy business, and therefore some premiums which have come last year definitely will not be repeated, but we are looking into more funds from other sources. And as regards GTL business, it has shown a good growth, and annuities are also continuing to show growth.
Okay, so the moderation is only because of the fund-based business. The profitable segments like GTL and annuity have grown.
Those are growing.
Yes.
Those are growing. Yeah.
Okay, perfect, sir. That's it from my side. Thank you.
Thank you, sir.
Thank you. Next question is from the line of Ajox from Sundaram Mutual Fund. Please go ahead.
Hi, sir. Thanks for the opportunity and congrats on a good set of numbers. Sir, if I just back compute the new business from individual non-par, the new business on the AP side of things, it seems to be a decline Q on Q. Is that what you are getting at?
See, non-par you are talking, I will give you a specific figure for 9 months.
Yeah, please go ahead. Yeah.
Non-par AP, which was
new business.
Hello,
can you hear me?
Yes. Non-par AP.
Yeah.
Non-par AP last year Q3 up to Q3 9 months 2022 and 9 months 23. If you compare earlier, it was 2,213 crore. As against that, currently it is 3,299 crore. So thereby we are showing 49% growth in total volume.
Yeah.
And the share also, non-par share also, as I mentioned earlier, it has moved up to more than 14%.
Yes, sir. I understand that. I was talking from the new business mix which you give at a proportion. You give the split of new business mix, and I am coming from the other non-par segment. Probably I can take it offline also in case you don't have the numbers available. But sir, again, the follow-up to Avinash's question, the others. Again, if you split the first half and 9 months, we see that the new products margins are phenomenal, like versus the industry is. So you mentioned that there is a case for you to come off and be more competitive. So if that is the case, how much will you sacrifice on the margins there to gain growth?
We have to maintain balance because growth is required as well as margin, both things. So it is, can tell.
Yeah, as we explained earlier also, this challenge is always going to be there. And that's what we have ensured that even in the 9-month period, while we have previously increased our rates, there has not been any letdown on the mix. So in certain products for sure, at certain point of time, when the competition, no market is without competition. So there, in order to remain competitive, we'll have to review. But then we continue to introduce new products also simultaneously. Ultimate aim, if you look at 16.6, we have to move from there upwards. On the margin side, that's the direction, and on the VNB side, we want to show robust growth also. So that is a very dynamic strategy about rebalancing the margin. But a very interesting point here to be noted here is that when we are having good margins here, the returns to the policyholders are also very good, and the products have been so designed in a manner so that it takes care of all the stakeholders.
Understood, sir. That's very promising. And sir, just one question, final question from my side is that sequentially, 2Q versus 3Q, except this new product which is propping up margins substantially, have we gained product level margins sequentially speaking, 2Q versus 3Q?
Product level margins, every product might not have gained, as I was saying. At certain point of time, certain products would be the leaders in the margin, certain others would have to be, because we'll also have to look at which are the points of competition, and then we'll have to review our offerings there. For example, recently, this annuity products, we have seen a lot of competition there. So then at certain point of time, you have to look into margin versus your growth strategy there. So the overall mix has to deliver, that's the strategy.
Yeah, I was talking from 2Q to 3Q perspective, historically, like 2Q versus 3Q, product level margins have broadly remained the same other than this?
Yes. Under the non-par, we can say, they have remained almost the same.
Sequentially, right? Okay.
And the non-par, and par also, when you ask about, we need to understand that when new product offerings are given, the customers can be very common. At certain times, they can choose the new ones. So, this small variations in the participating side also need to be seen in that context also. That when the greater offerings which are not earlier there, now when they come, people with preference towards them may shift. It's not necessarily because LIC wants them to take non-participating products. It's a customer choice. So these sort of variations from quarter to quarter or a certain period of years also can be seen.
Understood, sir. That's very helpful, sir. That's it from me, sir. Thank you.
Thank you.
Thank you. Next question is from the line of Aditi Joshi from JP Morgan. Please go ahead.
Yes, thank you for giving me the opportunity to ask questions. So I have a couple of questions. The first one is related to the non-par. Just if you are able to provide some details on it. The first one is, sir, can you please share the duration of these products, as in what is the typical duration as compared to your par products? And the second, can you also provide a split of the type of premiums which is coming from these non-par, as in split between a single premium versus the regular premium products? And from a risk management perspective, how do you plan to manage the risk from these products, especially from a perspective of investment spread management? As in, I just want to understand your thoughts, as in what challenges are you facing, or if not, is the asset management, asset liability matching comfortable at this point, or what challenges you might face in the future? The reason I'm asking is that, as you shared previously, that the mix that you're trying to limit is around 15%. So I'm just trying to understand what is limiting you to this 15% mix, because given the margins are pretty much higher for this product. And just a related one is that as you increase the share of non-par in your mix, how will it affect the unwind in your embedded value? Because the EV mix is largely skewed towards the value in force. And if you look at the EV movement, a large part of it comes from the unwind. So this is the first question.
Yeah, as far as you're pointing to that, there is nothing limiting us to 15% sort of level. The appreciable growth, as was mentioned earlier, from around 8% to 14% has happened because that's a strategic, efforts which have been made towards creating larger set of products, which, because as you all will appreciate that we are not offering many non-par products because of surplus distribution mechanism being in a different manner. And now that is being offered, so that there is a natural attraction towards it. That also because larger offerings are there, and there's a conscious effort also on that side. So there is nothing limiting that we shall be at 14%. Our aim is to provide products which are value addition for and good offerings to the customer, and they will pick and choose. And then automatically we will expect, because the people who are interested in guarantees will move towards non-participating products. People who want discretionary type of benefits will continue to take, and many people will like to take both type of products also, because they would like to guarantees as well as discretionary. So that is the element. As far as risk management is concerned, we are very cautious about how to ensure. In fact, very line of business wise specific calls are taken. You would see that larger distribution equity would be there in the participating product, which is discretionary. So therefore annuities are matched by long dated papers. So that where the cash flow matching is actually in tune with the investment assets there. Similarly, for the funds in the non-par side also, the larger proportion, in fact significant proportion, is towards fixed securities, and a very calibrated approach is taken. Their investment market is always full of risk, and our job is to ensure that the proper due risk management is done. So all the policies are in place, all the actions are taken, and we try to ensure that ALM, matching takes place, but within that, optimization returns can be ensured. So that's a very continuous activity which is undertaken, and that's why we are taking line of business wise as well as product wise approach on what should be the backing effects and how should their risk and rewards be decided based on the available opportunities there.
Thank you. Aditi, sorry, I'll request to come back for a follow-up question.
Oh, okay, sure. Thank you.
Thank you. Participants, we'll take the last two questions. The next question is from the line of Nischint Chawathe from Kotak Institutional Equities. Please go ahead.
Yeah, thanks for taking my question. I'm looking at your VNB walk, and this is slide 18. And what it suggests is that the impact of product benefits, over a 9 months period, and I know it's not directly comparable, but it's actually down minus 3.6%. And I know we've seen margin expansion, but it's kind of, I'm just trying to understand as to why is it negative?
Yeah, this is Ashok. Am I audible now?
Yes, sir.
Yeah. See, as was mentioned earlier, we have repriced annuities twice during the year. That is one in August and one in February. And that is the main reason why the margin was lower, contributing to a lower margin for the period.
Sure. And if I look at the impact of assumptions, right, this is 0.7% in the 9 month period versus 1.9 and 2% in the previous two presentations. So is it something that assumptions have been downgraded as well for this quarter?
See, actually, the major part of the assumption is the RFR change, on which we don't have any control. and it's a market-driven number. And the RFR is actually pushing the margins by the down south. And the requirements of the VNB calculation require us to update the latest information into the calculations. And we have updated the mortality element based on the recent experience into it. And that is done sometime in June 23. And these two are the major things that impact the assumption.
And just one small question is, if I look at the average policy term, that has gone up from in the non-par segment, has gone up from 16 years to 43 years. What really explains this?
Actually, if you look at the current quarter's performance, is riding on the product called Jeevan Utsav under non-par. And the average term, because that being a whole life policy, naturally shifts the average non-par savings term up.
No, but I'm just trying to see, first half the term was 16, 9 months the term is 43. Probably it means that, your term for Utsav that you sold in the quarter would be like 50, 55. And your average age is something like 32. So, is that how one should think of it? And that's where it goes to like 80 plus as a whole life policy?
Actually, since it is whole life, technically it is whole life, so it goes to the end of the.
And your assumption would be like 85.
Therefore, the projection period will also be till the end of the contract, and that tilts because of the huge number of business that is being done there. It tilts the average term.
But this is not the premium paying term, it is a policy term.
Policy term.
99 minus.
Policy premium paying term, is generally these are limited premium paying products.
That's it. Sure, that answers my question. Thank you very much.
Thank you.
Thank you. Next question is from the line of Supratim Datta from Ambit Capital. Please go ahead.
Thanks a lot for the opportunity. So my question is on the hedging mechanism. So could you let us know that, now that non-par has become around 14% of your AP, how are you...
Sorry, but your audio is not clear.
Can you hear me now?
Clear.
Yeah. So I wanted to understand the hedging mechanism for your non-par products. How are you hedging the risk now that it has become a substantial part of the book?
Yeah, there are 2-3 things to be appreciated. That first of all, as far as non-par annuities are concerned, there's not a great requirement for hedging there because their cash flow management, as long as you can get adequately matching duration long-term bonds which are available, 40-year bonds, for example, they have been there. So to that extent, the reinvestment risk is hedged because the cash flows coming from the coupons are very well matched to the payouts. As far as you will also another point of view, as of now, our portfolio in the non-par segment is not that big as proportion to the overall portfolio. But we already have, our derivative policy approved from the board, and we start to roll it out now onwards, so that future cash flows or reinvestment risk can be taken care out of it. As far as the current amount of volumes are there, they don't pose any threat in that context. But we are very conscious about it. Therefore, already the derivative policy is in place and it will start getting implemented very soon.
So just a follow-up on that. So now that you're rolling out the derivative mechanism or so that
Sorry, your voice
because that will come at a cost.
Your voice is breaking.
Can you hear me now?
Can you come in a better reception area, please?
Is that better now?
Yes, thank you.
Yeah, so I wanted to understand now that you're putting in place this derivative mechanism, how would that impact margins? Because this will come at a cost.
Definitely, that's why, we have not gone for it as long as your cash flows, generally derivative would be required largely when there are cash flows are an issue for an insurance company, more pronounced requirement for them. So we want to have that policy in place and make selective utilization of that wherever we need it. Because this is not only about the cost of derivative, but at times when the interest rates go up. So many challenges are there in that also. But the